Don't you agree that there are so many types of loan in Malaysia?
Well, yeah, but it's a good thing because it's a common financial tool used by individuals and also businesses in Malaysia, which allows these individuals to actually make a larger purchase or even investments that they would not be able to afford otherwise.
Yeah, imagine if there are no such thing as loan, you want to buy 100,000 car, oh, that's straight cash in hand, bro.
Yeah, well, let's not even talk about the car. Think about the house, man.
Yeah, exactly. There are several types of loan available in Malaysia, each with own unique benefits and features. So in today's video, we are going to talk about the basic different types of loan in Malaysia and how does it work, so you know the money that you're borrowing from the bank is worth it.
Yep.
What's up everybody, welcome to VC. My name is Vincent.
And I'm Chloe. Do you know that understanding the differences type of loans and how they work can actually help you to make informed decisions about your finances?
Yeah, sometimes people don't know that there are different types of loan in Malaysia, such as car loan, housing loan, SME loan, and also etc. Maybe most of you do know a bit about it, but do you know how does it really work?
Yeah, because many people thought that taking up a personal loan, the interest rate is calculated like a housing loan's rate. Sadly, well, to tell you, no.
Yep, and most of the people don't like loans because of the interest rate, right? So let's talk a little bit more about the interest rate and how they are different.
Yep, we won't be going in so deep today, so we'll keep it simple so everyone can actually understand.
Yep, so first of all, there are two most common loans. First of all is the flat rate, so which is also known as a fixed loan and also the fixed rate. These include car loan, personal loan, SME loan. The second one is also known as the effective rate, which is also called the term loan or also the variable rate or reducing balance loan to some people. These include housing loan, credit card, and also some SME loan too, depending on the banks.
So what's the difference? Well, fixed rate involves in an agreement where the borrower pays a predetermined amount in interest throughout their loan. Easy to understand, the interest of a fixed loan is calculated based on the original loan principal.
Yeah, this rate can be beneficial when borrowers expect the market rates to rise and they will not have to pay extra due to the rising costs. Yet, if the market rates drop significantly, then these borrowers may miss out on the potential saving with these options.
On the other hand, effective rate loans, also known as the variable rate, wherein the interest charge fluctuates depending on external factors such as inflation and also economic changes. The easiest way to understand is an effective rate loan is determined by OPR.
Yep, OPR in short is the overnight policy rate set by our central bank, Bank Negara Malaysia, that determines the rate of the interest rate for financial institutions that lends each other money overnight. So on a day-to-day basis, banks tend to have changing levels of cash reserves dependent upon the lending activities of the bank and those deposits with withdrawal of their own customers.
Yep, basically just how businesses work. So the higher the OPR rate, the more expensive it is to borrow money. You've probably heard people talk about how OPR was low during the pandemic season. Well, that's because the economy was low. That's where they lowered down the OPR to support more people into taking up loans.
Yep, as from there, you can already see that the variable rates is determined by the external factors such as inflation, economic condition, plus effective interest rate is also true interest rate that you are paying after considering the payment you have made to the loan and the effect of the interest compounding to the outstanding loan. Sounds confusing, but we'll jump into the calculation later on.
Well, benefits of the variable rate would be, firstly, your loan repayments decrease when interest rate falls, and usually you'll get better upfront perks with this rate. The interest rates for a variable loan is generally lower than a fixed loan, but nevertheless, loan repayments can increase when interest rate rises.
Yep, regardless on the pros and cons of each, it depends on the bank itself what package they are providing, right? And some banks don't actually let you choose whether to take up the fixed loan or effective loan. Therefore, knowing which loan is according to which rate can actually help you to determine where is your money going each month and also determine how much interest rate you are paying throughout the whole loan tenure.
Yes, exactly. Now let's dive into the calculation part of a fixed loan and also a effective rate loan. Firstly, fixed loan. Like we mentioned just now, fixed loan includes car loan, personal loan, and SME loans.
Yep, let's take an example. Today, David wants to purchase a car by applying for a car loan, right? The car is spotted X50, let's say the price is around 100,000. So he goes to the bank and apply for 90% loan, which is 90,000, interest rate of 3.4% with the loan tenure with 9 years.
The calculation for the monthly repayment for David would be starting from the loan amount, which is 90,000 times with 3.4%. Because the interest is annual, so we have to times another 9 years, making it 27,540 ringgit of interest in 9 years.
Yep, then you have to add the interest with the principal, which is loan amount, so it's around like 27,540 ringgit plus 90,000 equals to 117,540 ringgit.
Now, 117,540 ringgit would be the total amount that you're paying at the end of this 9 years tenure.
The monthly repayment would be 117,540 ringgit divided by the amount of months. So in this case, 9 years time times 12 months would be 108 months, right? So David's monthly repayment is 117,540 ringgit divided by 108 months, making it around like 1,088 ringgit 33 cents per month.
Yep, from this case study, it's kind of clear that the amount of interest that you're paying per month is the same throughout the loan tenure, and it's already calculated upfront too.
Yes, a common question by borrowers who take the fixed loan is whether they will need to pay the full interest cost for their loan if they have decided to settle it earlier.
In this case, if David, for the situation above, does he have to pay the full 27,540 ringgit interest cost if he settles the loan earlier? Well, in general, the bank will actually provide a rebate if the borrower decides to settle their loan earlier. So it kind of depends on the lender themselves. So do check the terms and conditions of your loan agreement. Most of the actual amount of rebate is provided by the lender is calculated using the effective interest rate calculation method to determine the rebate.
Yeah, the differences between the loan balance and also the early settlement according to the effective interest rate calculation method. Amount is the rebate provided by the lender. Sounds confusing, right? So be sure that you check with your bank before actually making the decision to settle your loan.
Yep. Now next, let's do a calculation for the effective loan, which includes housing loan, credit cards, and some SME loans too, depending on banks.
Yep, imagine today Ethan wants to purchase a house with mortgage loan. Let's say the price of the property is around like 800,000, and then he goes to the bank wanting to apply for 90% margin, which is 720,000, which with the effective rate of 4% and the loan tenure is 35 years.
So just to let you know again, it's a little bit different to calculate the interest rate paid for an effective rate since it's tabulated by the bank themselves. But for easier understanding, we'll just give an example for you to understand how it actually works.
The calculation for monthly repayment for Ethan would be starting from the loan amount, which is 720,000 times the interest rate, which is 4%, which is around like 28,800 ringgit. That's the interest paid for the first year.
However, in the second year, the interest charge will be 4% on the outstanding loan amount at the start of the second year.
Let's say assuming Ethan pays a total of 40,000 in the year 1, the outstanding amount for the starting of year 2 will be calculated by taking the original loan amount of 720,000 adding with the interest charge with year 1, which is 28,800, then deducting by the total amount that he paid for year 1, which is 40,000.
Yep, his outstanding balance at the end of year 1 is 708,800 ringgit. In this case, Ethan's interest cost for year 2 will be calculated based on 708,800 ringgit times 4%, which is 28,352 ringgit.
Yep, although it may not look like much difference on the interest paid for the second year comparing to the first year, but generally the graph for effective loan is the longer you pay, the more you pay into the principal, the interest paid will be decreased due to the calculation of the effective loan.
Yep, that's why it is called reducing balance loan, because as your balance reduces, the amount of interest that you're paying per year decreases too, which means you're paying for more principal, more of your principal, which is your initial loan amount.
Yeah, that being said, doesn't mean that you pay 3,000 for year 1, then suddenly year 10 you pay installment for like 2,000. No, but your monthly installment is separated into two parts, the interest part and also the principal part.
So your question now would be, what if I want to settle the effective loan earlier? Let's say after paying the loan for 15 years, I have finally collected the amount in my bank account that allows me to settle this housing loan. Do I still have to pay for the interest?
Well, if your loan is 35 years and you decided to settle your loan at the 15 years, let's say, you should not be paying the extra interest for the remaining 20 years. Hence, the bank will use the effective interest to calculate the effective outstanding loan balance. Let's say you get a jackpot lottery or something, right? So easy to understand, it will be calculated depending on the balance principle that you have according to the specific year.
In practice, some banks will have some charges imposed for early settlements. Therefore, the actual early settlement amount will be the outstanding balance plus charges, while some banks do have a lockdown period where in the first specific years, borrowers cannot actually do early settlements. So do check with your banker on this if you have any plans to actually do early settlements in the near future.
Yeah, so these are the two main types of calculation of interest rate, fixed rate and also the effective rate. Ultimately, understanding what each interest rate entails is essential when you're considering any loan or credit product in Malaysia. By carefully researching and comparing various options, and you and I can make informed decisions about which loan structure would the best suit them financially and help.
And here's the end of the video. Thank you for watching. If you want to understand more about OPR, you can watch this video right here.
Yep, and if you're still in the midst of considering whether to purchase a property or not because someone said the economy is bad, you can watch this video right there instead and determine whether it's a good time for now to purchase a property or not, right? And we'll see you in the next video.
Ciao!